Good morning, Baker investment students. It is Sunday, December 4th, 2022. So I hope everyone is having a great weekend, and hopefully those Chiefies get a win against the Cincinnati Bengals today. I think they have a 3:15 game today. So for this week, just make sure to wrap up week 5 and your chapter 4 homework, and I hope to have those graded by Monday, Tuesday at the latest. We're already in week 6, so we have just 2 weeks left. So we're coming down towards the end. Hopefully you all get a little bit of break after the last class. I think it starts back up January 2nd because I have a class at Baker starting then too. So just try to finish strong, and do ask me questions if you have any questions. But for this week, we do have the task stream assignment, so do make sure to upload it to Moodle and also task stream, so on the current investment topic. My suggestions for the this paper is obviously kind of say, like, let your references and sources write your paper. Obviously, you want to look at the prompts. It's a world event. I'm going to give you an example like the subprime crisis that happened in 2008, 2009. Obviously, when you're looking at those prompts, look at the rubric, trying to address all those questions. So that's what I'm going to be looking for. But if you think about the subprime crisis, it was basically caused by credit default swaps that people really didn't understand. It was basically an insurance against mortgage-backed securities. And when the housing market failed, all these Wall Street firms that wrote these credit default swaps made a lot of money on them. Never really had the money to cover any of these losses. So it was a black eye on regulation and understanding what these things were. But, it required a lot of intervention by the Federal Reserve and the world to recoup from that. Some people lost almost 50% of their entire portfolios, including my mother-in-law lost like 40, 50%. And she's never really quite recovered from that loss, even though that was well over, we're looking at 15 years ago. So, but, you can pick other events. Even the war in Russia right now has impacted financial markets in different ways. The U.S. rising inflation or world inflation could be an event, and how that's impacted decisions and interest rates, and that's impacted bonds. It's been impacted the stock market tremendously this year. So there's a little bit of hope this week that the Federal Reserve, probably in their December 13th through 15th meeting, they're backing off now. They're not going to raise interest rates as much. It's only going to be maybe 50 basis points. So they're cautiously optimistic and try to put the brakes on a little less, and we'll see what happens. So, but again, if you do have any questions, do email me early in the week. But that's your big task, is try to get that out of the way, that task stream assignment. So with this week, chapter 11, chapter 12, you're going to be first looking at bonds. That's kind of a technical chapter, but with bonds right now, I think I mentioned this before, bond funds are just getting beat up. We can tie it into chapter 12 because it talks about mutual funds, and there are many mutual funds out there that are bond funds. In fact, I own some through Fidelity, like a corporate bond fund, a corporate investment grade fund, but they have just done horrible the past 3 years. If you looked at like their 10-year returns, it barely ekes out like 1 or 2%. And the reason is because when interest rates go up, the present values of these bonds go down, so they have to market price to price, price called mark to market. And as I mentioned, the Federal Reserve is probably going to raise interest rates another 50 basis points. So that just means that bonds that are out there that have long maturities, that were at very low interest rates, are worth a lot less. So investors are going to say, hey, why do I want this low rate return when I can go out and buy something with similar risk at a much higher rate? And plus the fact that inflation, if you're only getting like a 1 or 2% rate of return, your actually real return is much worse off. It'd be a negative real return. So you're going to look at a lot of calculations in that chapter. Look at things like yield to maturity, current yield, yield to call. You're even going to look at duration, which is a way to measure the volatility of a bond by using a mathematical concept. Was created by Macaulay. But basically, you're looking at the present value of these bonds and the interest rates, and kind of using a weighted factor. And the idea basically is that the shorter the duration, the less the risk. So, but obviously, that the longer that it takes for the bond to mature, and the bigger swing in interest rates, that's what we've seen bond funds and bonds in general takes such a big hit. So, you think with bonds that, okay, I just buy a fixed dollar amount called fixed income, $1,000. But again, because they have to price it mark to market, as if you were to have to sell it today. That's why bonds have done so horrible lately. So, and then your last chapter, chapter 12, you're going to look at mutual funds. A lot of you should be somewhat familiar with mutual funds just with your own investing through your retirement portfolios. Generally, they ask you to invest in different types, or they give you different types of mutual funds to invest in. Like I've always said kind of along that I'm a big fan of the S&P 500 index fund. There's not rocket science to it. It's kind of buy and hold strategy, but most professional money managers have a hard time just beating the S&P 500 index mutual fund. So you're going to look at things about how they calculate the net asset value. You're going to look at the different types of mutual funds. You're going to look at the performance and the risk, and even some discussion of exchange-traded funds that act like a mutual fund, but allow a buyer or seller to go to exchange, so you don't have to wait till the close of the day to see what the net asset value is. And a lot of times these exchange-traded funds have a little bit of a premium or bump in them. There's not guaranteed, but you're probably paying a little bit more than what you would exchange-traded fund for anticipation about how the fund managers may do in the future. So, all right, that's it for this week. So again, really looking forward to your last. Great job again with the forum discussion post. You got one last one to go, and that's it. But otherwise, do email me if you have any questions, and I hope you have a great week, and we'll talk to you online. Take care.